Hi everyone, it's Jason Baracco of Wall Street from Main Street. Today, Mo and I are going to do our 2016 review today. We'll be talking a little bit about a preview of 2017, but mostly a review of 2016. It was a very interesting year, Mo. There was lots of interesting current events. We had the Federal Reserve come out and promise 4 interest rate increases in 2016. We only got 1. And we had, in January, right, we had a stock market correction in January of 2016. And many people saw that as a bad omen, and yet what happened the rest of the year?
So, well, first of all, Happy New Year, Jason, and Happy New Year to all of our listeners. So, yeah, 2016 was a very interesting year, a very unique year, politically, economically, socially as well. Starting off with the Federal Reserve, raising the interest rate. I think they raised it twice. Is that correct, or that just one time?
Well, they raised in December of 2015. So they raised December 2015, gold started to take off, so they only did 1 in 2016.
Okay, that's right. That's right.
Yeah.
So they only did 1 this year when they said they're going to do 3 or 4, and they just released their meeting note from their December meeting, and again they're trying to raise the rate 3 or 4 times in 2017. I don't think they will. I think they might just do 1 again for 25 basis points, which is really nothing if you look at the chart for the Federal Reserve and the interest rate and what they did when Paul Volcker was the chairman, when they raised the interest rate above 10. Now that's something that the economy might need, even though it might be painful for the short term, but in the long run, we'll be better off if we had a little bit higher interest rate to correct a malfunction that we have in our economy.
Yeah, the dollar index, Mo, is already at a 14-year high, surprisingly, despite, the Federal Reserve's balance sheet going from $800 billion before the 2008 financial crisis to over $4 trillion. This is the number they've given us. I'm sure it's probably more than $4 trillion right now. So, the Federal Reserve, these guys are basically politicians. They want to try to manage the dollar. They don't want it too strong. They don't want it too weak. They're trying to control exchange rates. And they're not the only central bank trying to do this with their interventions. But you mentioned a key point there about the number of interest rate increases. The Federal Reserve said they would do 4 in 2016. We only got 1. Okay, and I don't know how many people on Wall Street still give them credibility. You and me, Mo, don't give them any credibility, but there's still people on Wall Street that still give them credibility. But, now in 2017, they're promising 3 as of right now. I would put 3. Nothing in life is guaranteed except for inflation, except for death, taxes, and inflation from governments. Governments trying to devalue their currency. So, normally the 2 things that are guaranteed in life are death and taxes. I'll add inflation into there because governments are always going to try to cheat with the stealth tax or inflation tax. But I would put 3 interest rate increases in 2017 with an already strong dollar in the dollar index at a very low probability event. The only way I see 3 interest rate increases, Mo, is after Donald Trump has already taken office and the Democrats at the Federal Reserve decide, you know what, we're going to crash things now. With Trump in office, we're going to blame it on Trump. We're going to do the reset now. We're going to try to take more political power, and we're going to try to limit Donald Trump to 1 term. Otherwise, I think I agree with what you said. It's either the higher probability is either 1 more token interest rate increase of 25 basis points, which is basically nothing, or no interest rate increase at all. We've even heard people say that they're going to have to go back to some type of quantitative easing. If they actually announce a money printing program like quantitative easing, there's a lot of people that know those words now. So, I've talked about this in other interviews. I think the Federal Reserve is more likely to do some type of covert liquidity program as opposed to, announcing that they're doing QE programs of direct, asset purchases or bond buying. They're more about doing, still putting the liquidity into the system, giving Wall Street their bailouts, and their free asset purchases so they can drive them higher and make bonuses. But, doing it more covert rather than Ben Bernanke or whoever, Janet Yellen coming out and announcing the next money printing program. I think they would only do that, Mo, and announce an enormous program if we had a major stock market crash, a la 2008 or something like that in 2017. They would actually announce, large that we're going to do another quantitative easing program of $100 billion a month. We're going to buy up, these junk assets or either these these derivatives, the subprime auto loans, we're going to buy up those, or oh, we're going to buy up shale bank debt from insurance companies or pension funds, or oh, we're going to start buying up student loan debt, etc.
Yeah, I agree with you. I think the only way they would increase the interest rate more than once is just to try to sabotage Donald Trump presidency. But I think the Federal Reserve realized that they're handcuffed right now. If you look at the amount of debt that the U.S. government has, and it's approaching $20 trillion. And if you just do the math on that, that's a very big monthly interest payment or yearly interest payment for the government to try to pay off. So I think I know they know that they can't raise it that much without trying to practically bankrupt the U.S. government. But with Trump pro-growth agenda, another argument that you can make that there might be concern that we'll see higher inflation if we see more growth in the economy with his pro-growth agenda. So it might even force the Federal Reserve to raise interest rate higher if we do see that, similar to what we saw right before the housing bubble collapsed a decade ago.
Well, Mo, during the election, Donald Trump said, he correctly said, in my view, that the stock market is a bubble. Interest rates are artificially manipulated lower by the Federal Reserve. He was talking like Ron Paul for a couple of minutes there during one of the debates. I think it was the second debate. And he was saying how politicized the Federal Reserve is. So I agree with him on that. But, now that he's gone to office and started laying out some of his policies, it sounds like he wants supply side economics, a version of Reagan economics. And in order to do that, he needs low interest rates. So, if interest rates start to rise, he can't borrow as much as he wants to fund this improvement of military and defense upgrades. He wants a lot of things upgraded. He wants to either build a wall or some type of investment in our border security. And then he also wants the infrastructure. So I know he's working on creative ways in order to fund these things, some type of privatization or mixed model, some sort of use of it. Getting the private sector to fund some of it, but I mean, the government's going to try to do some of this borrowing. So, when I look at this, I kind of see that inflation is going to win one way or another. So if Donald Trump is successful, Mo, with his infrastructure and spending programs, that velocity of money that we haven't gotten in the real economy in the United States, that would start to pick up. So we would see some commodity prices like base metals, food, energy. We would see workers' wages in certain industries start to rise and people would start to spend that money again. Velocity of money would pick up. That would cause more inflationary pressure in the U.S. in the real economy, as opposed to the monetary inflation we've had since the central banks have intervened after the 2008 financial crisis that has rocketed asset prices to ridiculous valuations. So, the real economy, I see a lot more inflation coming, whether that's Donald Trump's programs are successful or not. If his programs are not successful, I see the debt accelerating, like you said. I see the market maybe starting to panic and increasing the interest rates in the bond market, the bond vigilantes, some free market forces in the bond market, and higher interest rates, plus the debt problem, the total size of the debt continuing to grow. I mean, we're almost at $20 trillion already. We have almost 20,000 Dow. We have almost $20 trillion on our debt. And the debt's going to start growing faster if Trump starts spending this. So, and that could add inflationary pressure as well. Because who's gonna buy the debt then, Mo? We've seen evidence of this. There's tons of zero hedge articles that China and Saudi Arabia have been dumping a lot of their treasuries in 2016. Now, for a treasury market, Mo, for every seller, there's a buyer, okay?
Yep.
But we don't know who the buyers are. So it could be that the buyers are a subsidiary of the U.S. government, could be a subsidiary of the Federal Reserve, could be a subsidiary of the U.S. Treasury, could be a subsidiary of the Bank of International Settlements or Exchange Stabilization Fund. They create these weird categories in the TIC reports, which are for who buys the treasuries. They create a Caribbean one, which is a lot of people have agreed on that, have looked into that. They think it's a secret offshore area where like the U.S. government has secret buyers of last resort set up. So it'll be interesting to see if we do get an interest rate spike, Mo, and there is inflationary pressure, and a lot of people on Wall Street who say there is no inflation now start to finally acknowledge that. Who's going to step up then and buy those treasuries?
Yeah, I always thought that the Federal Reserve had been the #1 buyer of U.S. Treasury for the past 5 years, ever since China started to reduce their holdings in treasury bonds. But I remember also, what was that European country that came out and
Belgium.
yeah,
Belgium.
Belgium, yeah,
But
Belgium.
it's rumored that China may have used that as a proxy, or the Federal Reserve could have printed the ECB off the money with a currency swap to buy it. So we don't know if the Belgium doesn't really. They're not a big country, so they don't have the reserves to actually buy them. So they were an intermediary. They were a broker for that transaction. We don't know who was the real buyer though.
Yep, I agree. Um, so let's shift gears here and talk about the U.S. dollar, which made news last week, 14-year high, which may be surprising to a lot of people. But if you think about it, it makes sense. Right now, the U.S. dollar is what I've been saying in my last podcast, the best house in a bad neighborhood. We're seeing capital control in China. We're seeing India get rid of their 500, 1,000 rupee currencies out of circulation, which is hurting the lower middle class in India right now. We're seeing the euro struggling right now due to the Eurobank collapse, starting with Deutsche Bank and also the Italian banks. But pretty much all the banks in the European countries are in trouble right now. So I think all that is benefiting the U.S. dollar, so we're seeing a rise in dollar, and also combine that with the Federal Reserve slightly raising the interest rate.
Yeah, and let's add in there too that the global economy, there's just so much evidence that the global economy has slowed down a lot too. So you have a situation here where the worse the global economy gets, the more skittish a lot of money managers get, and they start selling out of other currencies and other assets and into safer, more safe haven stuff, either cash U.S. dollars, U.S. treasuries, or U.S. assets like the U.S. stock market. So we've seen capital flight, like Mo said, for a bunch of different reasons come into the United States. I think there's a bunch of different reasons why the money has come in here, and that the dollar, no central banker, whether you're in Japan, the United States, you're at the European Central Bank, you're an emerging market central banker, no central banker wants a strong currency. Okay, none of them do. Now they may take turns in the currency block of the U.S., Japan, and the European Central Bank and England, devaluation with their exchange rate. They may take turns with devaluation, but no one wants a strong currency for a while. And what we've had, Mo, here, this is reminiscent. I like to study history. This reminds me of how a lot of global markets and other stock markets were doing very poorly prior to October 1929. You can go back. It was very obvious if you study financial history then that a lot of other countries were in depressions or enormous recessions then, and a lot of flight capital started coming into the United States. So we have that situation now. Now, I don't know if we're going to have an immediate stock market crash. I'm not one of these guys trying to, pump a newsletter and say that it's guaranteed we're going to have a stock market crash, that, the stock market's going to get cut in half in the next couple months, or gold's going to get cut in half or anything like that. But, we're setting up to the point where a lot of money has left these other markets for whatever reason. China has a liquidity crisis. Have you seen the news that's coming out recently? They have a huge problem in their banking system, huge liquidity crisis. We know there's bad loans from their municipalities as well. They just did an emergency. Not only do they have capital controls, Mo, they also did a currency devaluation. So if you were a prudent Chinese businessman and you had a lot of cash in the bank in China, they devalued you, 6%. A month or so ago, they devalued you 6% overnight. So in the span of a day or two, I mean, if I would be pissed if I had a lot of cash in the bank and that happened to me. So people aren't just going to sit there and take it. And that's why you're seeing money move around. That's why you're seeing the price of Bitcoin go crazy in 2016. Besides the fact that a lot of investment has been made by Wall Street, Silicon Valley, large corporations into blockchain technology companies, in the infrastructure there, you're seeing a lot of people in those emerging market countries, like you mentioned, Mo, the Venezuelas with hyperinflation, the India demonetization scheme from Modi, who was supposedly pro-business and pro-gold. You're seeing people that have never bought Bitcoin or owned gold or silver for the first time start to go into these markets, out of desperation to try to save themselves.
Yeah, and it's not like the government want a strong and sound currency right now. And what's also hurting the U.S. dollar is what also hurting the negative effect for U.S. dollar is the corporation that have exposure or have business overseas. So we should expect to see some earning revision coming forward if the U.S. dollar continue to go up higher.
Yep.
So it'll be interesting
Good.
to see how
Great
the stock
point.
market react to the strong U.S. dollar.
Great
Stronger
point.
U.S. dollars. Yeah.
Great point, Mo. And from a fundamental standpoint, you brought up there now that the earnings are going to probably miss because of the stronger dollar. So the other thing I would mention too as well, and I just saw an article on this today, is that now share buybacks are now down 28% from the previous year. So third quarter 2016 compared to third quarter 2015, share buybacks are down 28% now. And share buybacks, Mo, are what the corporate executives of these large corporations have used to buoy the stock. It was a game they were playing to trigger their stock options. They didn't care if the shares were undervalued. They just cared about, beating earnings, moving the stock price higher in the short term for the next month, next quarter or two, so they could trigger their stock option bonuses so they could get rich quick and retire a lot sooner with their golden parachutes. So we see evidence now that that is slowing down as well. So we're starting to see now headwinds about the stock market. You had on Eric Haydick. That was an excellent interview earlier this week, and he said the stock market is slowly putting in a topping process. I think it's a fool's game to try to pick the exact time the stock market's going to crash. When we wrote the 2016 review, we thought around election time things could get pretty bad. We had a big roadblock in January of 2016. The stock market had a big correction, and then pretty much for the rest of the year, Mo, it started to go back up. I mean, if you look at it, the gold and silver were doing very well for most of 2016 until September, October, but then the Dow ended up outperforming gold. So, the money it seems that a lot of, whether it's the retail money here in the United States, we see evidence that billions of dollars in cash and bond funds of retail clients here in the United States have left into stocks. And then also the flight capital out of other countries, that money has gone into the stock market, U.S. stock market as well. And like I said, this is reminiscent of what happened prior to the October 1929 crash, where people of affluence and money managers in many different countries started moving lots and lots of money here in the U.S. because the U.S. hadn't crashed yet. The U.S. wasn't in a full depression, and their stock market hadn't crashed compared to the other markets.
Yeah, and I was looking at the chart, and I had concerns about the stock market going into a downtrend because right before the Trump rally, the Dow Jones and S&P 500 were about to break the 200-day moving average, which is usually a bearish sign. But then we had the Trump rally, and everybody saw it with Trump won that the stock market would go down. But I guess Wall Street is loving his economic policy, and that the fact that he has two Goldman Sachs insiders in his cabinet, so I guess they're not too concerned about Donald Trump.
That could definitely be a factor, Mo. It could also have been the plunge protection team, because right when it would look like Trump was basically had won the election and Hillary hadn't conceded yet, on election night, when basically It was over, we had an 800-point drop, right, in it the S&P 500 or the Dow? It was an 800-point drop, and then we had a $70 move up in gold, and by the time I had gone to bed and woken up, the thing had totally reversed. So something had come in there. I don't know if it was a plunge protection team or not. It probably was, and reversed that trade from going on and just rocketed things back.
Yeah. And right now, it's trying to break that Dow Jones, trying to break that 20,000 point resistance. It's having trouble right now, so we'll see what happens with the stock market going forward. It's going to be an interesting year. And if you, I think you that sent me that article from Zero Hedge looking at the valuation of the stock market in general. Zero Hedge released an article back over the summer, and the article had a table with financial ratios such as the PE and other ratios that they compared it to the tech bubble. And right now, everything is all the financial ratios is above the average of what we had during the tech bubble.
Yes, I was watching CNBC today, just very briefly. I didn't watch it very long. And billionaire investor Leon Cooperman was there. He's former Goldman Sachs top hedge fund manager. And he was saying basically he thinks the stock market, from talking to different people and doing analysis with his valuation metrics, he thinks the stock market's up to 50% overvalued. So he said about fair value would be about 13 times for a large cap dividend paying stock, share of the Dow. And he said right now, according to Robert Schiller, the cyclically adjusted price to earnings ratio, or CAPE, is around 27. So it's very high. You mentioned that article, Mo. We'll put a link to our listeners to show that. It is from the summer, so things have gone higher, but there's a bunch of different valuation metrics on there. So whether you're looking at forward PE, regular PE, enterprise value to EBITDA, there's a bunch of different valuation metrics you can look at, and basically, Mo, every single one of them says it's drastically overvalued. So, I'm not saying when you look at these things, it doesn't mean that the stock market's going to immediately crash. Things can go higher. It just means that fundamentals are not driving this stock market higher. So it just means that, people are chasing momentum. It could be flight capital, like you said, or it could be, all central bank buying. We know that not only is the Federal Reserve expanded its balance sheet, we know that, the Swiss central bank has been owns over $60 billion worth of U.S. stocks. We know that the European Central Bank and others are buying assets like corporate bonds. We know that the Bank of Japan in 2016, Mo, was the largest buyer of Japanese stocks. So if the Bank of Japan had not come in and bought lots of Japanese stocks, the Japanese stock market may have crashed. And we know that the Bank of Japan is the largest holder of Japanese government debt too, besides the pension funds. So, this is all one giant fustercluck or clusterfuck. Whether I cuss or not, I'm still going to get emails or comments. So I did both. So if I cuss, I get comments. If I don't cuss, I get comments. So I did both. But this just goes back to the analogy I use. We have an economic minefield. So there's so many problems in so many different economies. In the U.S. economy, Mo, we can talk about all the different problems we have in the U.S. economy. So we have this student loan debt crisis. We have the subprime auto loan bubble. We have a huge pension fund crisis, which with the pension funds are underfunded by 4 to 7 times, and that's at many different levels of municipalities, state governments. That's lots of different states for their teachers unions and their state government employee unions, pension funds. We have people holding over $1 trillion in a lot of cases of bad oil debt. There's a lot of insurance companies and pension funds sitting on bad oil debt right now. We have a bubble in commercial real estate. One of the side effects of Dodd-Frank and more rules and regulation to try to stop the banks. I don't know if this was intentional or an unintended consequence or not of Dodd-Frank, but it incentivized the banks to, instead of loaning to small businesses, the commercial real estate in other industries, commercial real estate got a lot of the loan money after 2008 once Dodd-Frank was passed. So that's fueled the new commercial real estate bubble in the United States. I mean, we could go on and on and on. Besides, the subprime auto loan bubble and so many of we have the shale oil bubble. So if the oil price is around 50 something right now, low 50s. I think last time I checked, if the oil price, has another 20% correction, we could be in really bad territory. If the base metal prices have had a bear market rally recently, due to whatever reason, I think it's a bear market rally. I don't think it's based on fundamentals necessarily, but if we have, another 20 or 30% drop again in base metal prices, say back to $2 copper, and it stays there for a while, we could have bad loans from the banks again, with the mining companies, a lot of them, or the companies like Caterpillar. So we could have problems with that. And then you add in the European banks. So the European banks, Mo, after 2008, they weren't recapitalized like the American banks are. Not that the American banks were fully recapitalized, but they were, compared to the European banks, they were at least a lot more recapitalized because of TARP and the other Federal Reserve programs. What we also know, Mo, is that the European banks were given $10 trillion just for themselves in currency swaps. after the 2008 financial crisis, and even that $10 trillion wasn't enough. That money's probably already gone. It's probably hemorrhaging in the derivatives market.
Yeah, and even just Deutsche Bank derivative book is valued at $42 trillion. So $10 trillion is like nothing, not even remotely enough to try to recapitalize the European banks. And that's the problem they're having right now. It's trying to keep the bank in Europe capitalized, and the stock for Deutsche Bank has completely become worthless right now, and the Italian banks are following suit, and all the other banks in other European countries are having the same problem, and and the banks here in America have that same problem too.
Yep.
They're not properly capitalized, and they're still taking a lot of excessive risks and derivative and taking subprime loans, especially in the auto industry. So. And also interesting to note that a lot of people thought the European bank problem could be the potential black swan that could crash the global economy again, but it hasn't happened yet. But something to keep our eye on for this year and upcoming years as well.
Yeah, I agree. And I think there's reasons why this hasn't happened. And I think it's going on behind the scenes, covert and currency swaps. There's these secret liquidity programs that go on, or rules are changed. We have the politicians putting in place these weird bailout programs. We had the Federal Reserve issue a press release last month saying that they think that the U.S. and European banks only need $70 billion in capital injections in order, according to their research, and that they don't want to do any more, Federal Reserve does, and ECB don't want to do any more bank bailouts, but they want the banks to sell shares of bank stocks and issue long-term debt. Well, if the central banks aren't going to buy them, Mo, and we know the governments, the treasury departments are basically broke, they're in record amounts of debt, who the hell is going to buy these bank stocks and this long-term bank debt that they're going to sell? So it sounds like, we're going to totalitarian government. There's going to be a combination of secret covert bailouts and then that are backdoor, and then some type of bail-in where if you have a retirement account in Germany or France or Italy, and you have a retirement account in the U.S., which is a 401k or an IRA, they're maybe going to ask you for national security purposes to maybe in the future put 1 or 2% of your assets into either government debt, government bonds, or banks, or to buy bank stocks or bank bonds, maybe some combination of those things. It's just ridiculous. And unfortunately, I think a lot of people are going to go along with it for a while because people are starting to wake up. They're just not fully aware of who to blame for all this crisis right now. But we are starting to see in Europe, Mo, we saw this with Brexit. We're seeing this with the Italian referendum vote recently. People in Europe, they've been taxed to death. When they joined the euro, they were normally devalued into the euro. We've heard that from our listeners. That wasn't mentioned a lot by the financial media, that there was an initial devaluation just to get into the euro. So they've been killed with inflation and taxes. If you compare the lifestyle of people here in the United States to the lifestyle of people in Europe, they have smaller houses, smaller portions of food. That's a much lower standard of living. And yet, we have people talking about higher taxes in Europe, and they have an immigration problem with George Soros and these open borders. We're seeing the taxpayer revolt. So we have the taxpayers now, whether it's England with Brexit or other European Union countries, they don't want to pay for any illegal immigrants to come in and steal benefits that the taxpayers can't pay the tax increases for and or steal jobs. This is not going to continue, and they don't want to do bank bailouts. So something's going to have to give in the future. The elites, Mo, like George Soros and these other scumbag elites, these politicians, they want open borders for whatever reason. They want one world government. They want more rules and regulations. They want to move, they want the IMF and the SDR if there's a next crisis. I don't want these things. But, the elites have their academic PhD economists writing these stupid freaking white papers talking about when there's a next crisis, how they're going to print more money and do more trillions of dollars. And, what the elites want is this SDR liquidity pump because the dollar, if it gets too strong, it can basically destroy the global economy because we have over $9 trillion now in emerging market government debt, combination of emerging market government debt and corporate debt in emerging markets in dollar denominated. So when their currency, their own currency in those emerging market countries gets weak against the dollar, and then they owe their debt in a stronger currency, the dollar, it becomes more burdensome. So this is setting up, if the dollar continues to strengthen, Mo, this could accelerate some type of collapse as well. I think this is why central bankers, they want to try to pull all these levers. They want a controlled devaluation of their currencies, like Goldilocks and the Three Bears, how with currency devaluation. So they don't want too hot or too cold. They're trying to move it just right. And you know how it is with central planning and intervention. It's not going to end up just right.
Yeah, it usually doesn't end up well, and at all fiat currency, they end up going to zero and becoming worthless. So we're heading into scary times. I think we're getting to a time period where we're going to see a shift in our economy, in our political landscape, and in our social landscape as well, due to the big government and constant intervention by the big government, whether the consequences are intended or unintended.
Oh yeah, we're already seeing that shift now. We're switching from more of the elites controlling the media, controlling the way we think in government schools, and the fake news mainstream media that runs a lot of propaganda, whether it's with government-controlled media like the BBC or corporate fascists here in the United States with the big media like that. We're seeing it switch to more of nationalism. Nationalism, I'm a libertarian, so nationalism, there's good things about it, but it can also be dangerous. But it's better than the globalist system right now where, they're taking away our rights. They're making us pay more and more taxes. They're devaluing our currencies, trying to destroy us, and they're taking away all our freedoms. So, hopefully we will transition to less government, and, governments will get out of intervening in the economy and intervening in markets, leave us alone, let people run their small businesses. I would love for everyone to have the opportunity to start a small business and flourish, be an entrepreneur, have more freedom and lower taxes. But it's going to be a fight. So we see this with the lawyers, the elites. A lot of the elites in power have very expensive lawyers if they're not lawyers themselves. And, we see this with Brexit. They're fighting it. They're fighting it in courts. I think it's still about 2 years to go before Brexit actually goes through, and it's being fought like crazy. And, Trump is definitely a nationalist. He's not a Republican. He's more of an
he's an economic nationalist.
Yeah. He wants to put on tariffs, which are dangerous. He wants to put, these high tariffs on goods. These things. Now, go back through financial history, look up Smoot-Hawley. I was going to do a short video on this. Maybe I will do one on Smoot-Hawley. There's great articles on Smoot-Hawley, both on the Mises website and on the Foundation for Economic Education website. But, Smoot-Hawley didn't cause the 1929 Great Depression, Mo, but it definitely extended it and made it a lot worse. Yeah. So there were situations, with Smoot-Hawley where farmers, if they would have sold the prices of oranges and other crops that were grown, people who were poor, who had a little bit of money, if the prices on those goods would have fallen, they could have afforded to go buy the food. And the farmers, with price controls and wage and price controls, the farmers were basically paid a big subsidy to grow the food and then let it die in order to try to maintain a high price. So this led to people, being out of jobs and also, increased starvation. And there was more, soups and bread lines. But, people could have been able on their own to actually afford things at lower prices. So they intervened in the market. It's very dangerous. There's also, I was reading Jim Rickards' book, new book, Road to Ruin, last month. And he says as one of his prescriptions for fixing things that, high tariffs didn't destroy the U.S. economy, that high tariffs actually allowed the U.S. economy to grow. I would have to go back and look through research to see if he's right about that or not. But we know what Smoot-Hawley did. So we know Smoot-Hawley. I'm sorry.
Yeah, finish. Go ahead. I was gonna make a comment, but I'm gonna let you finish.
Yeah, that's all I wanted to say. So if there's some counterpoints to Smoot-Hawley, okay, maybe. But I would prefer free market. So I would prefer no politician and no government, whether it's corporations, governments in Japan or South Korea who have huge tariffs on American cars. to protect their own industries. I would prefer none of these politicians did this to any of their goods. And the consumer in all these different countries, would they have the ability to pick whichever good or service around the same price is of higher quality, and that one wins. They vote with their money. But that's not what politicians in many countries are doing. Most politicians in many countries use tariffs to protect a lot of their goods.
Yeah, and tariff hurt the consumer because they end up paying more for the goods and services that they're buying from another country.
Yep.
And right now we're gonna probably see a rise of economic nationalism in this country because a lot of people are not don't understand how free trade or the economy work and what the benefit of free trade is. They only see that the jobs are being taken away and are moving to China or Mexico to keep the labor costs low and the cost of business low. And the reason they're doing that is because the cost of doing business here is so high. Yeah. So they're moving all the jobs to other places. So yeah, instead of blaming the companies, you want to just tell the government to stop, passing all these regulations and increasing taxes all the time.
I agree, Mo. And even if those jobs come back, some of those factory jobs, they may not be higher paying. So they may be low-wage factory jobs, and then they're going to increase the cost of the goods here. So the consumer is not going to be able to afford as much. What we really need is we need an economy where if there is jobs destroyed via creative destruction and some free market forces, we need lower taxes, lower regulation and red tape. The lower regulation and red tape and small businesses having access to more capital is really key. Congress is going to open it up so retail investors can start seeding, make it easier for retail investors to invest in seed capital in startups. I'm not sure how exactly that's going to work yet. I haven't researched it a lot, but that could help a little bit. But we really need a lot more of that. So we're going to need the U.S. in the past, Mo, when there was less taxes, less regulation and red tape. So let's give a historical example. That's the best way of me instead of rambling on and on. So there was a lot of people when automobiles were first being developed and invested in here in the United States who were worried the U.S. economy was going to be in trouble because of all the horse and buggy whip people who are going to be out of jobs, right? So when the automobile industry, Henry Ford and the other guys, and General Motors and the Dodge brothers, etc., were working on automobiles here in the United States, there was tons of people worrying, we need to regulate the automobiles. We need to stop it. The horse and buggy whip people, if they lose their jobs, is going to destroy the economy. No. So, and look, the U.S. economy became an industrial powerhouse. In England, there were all these rules and regulations for the automobile manufacturer in England. And that's why England was not ahead of the United States for manufacturing automobiles. That's why England, even though England was further economically than the United States at that point, that's why the U.S. beat them at manufacturing automobiles and innovation in that regard. So we need to open this back up where we can create a lot more new industries and entrepreneurs like you and me who are researching this in educational technology and other industries, that's an industry ripe for disruption, right? As our college, universities, the educational system, there needs to be easier access to capital for innovative entrepreneurs like us who can bring some type of new efficiency and create more value added to this.
I think another concern people have is that the rise of robotic and automation, all the jobs, if they do come back, they're going to be replaced by machines. But with the rise of the robotic industry, it comes with new jobs because, for example, if one of the robotic breaks down, they need a person to go in there and fix those things, just for example. So with a new industry that is being born comes with a new opportunity and more jobs. So I'm not saying all the job will be completely replaced with a new job from the automation industry, but with technology, it makes things more efficient and keep their prices low for the consumers, and it creates more jobs. So it's not all that bad.
And the U.S. has a lot of good technology people. Okay, that's one of our leading areas that what we can do. So we just have to try to innovate in more different industries. I think there's a lot of good IP that's being blocked in the patent office that we could open back up and create new industries. So most of the job growth, Mo, comes from small business. And yet a lot of these, whether it's the Obamacare tax or the corporate taxes, it was hurting small businesses more than it was hurting large corporations. So, Congress and lobbying lawyers were trying to raise taxes on corporations. The corporations could afford the money to move on paper to Ireland or move on paper to Switzerland. They could afford the most expensive tax lawyers, tax attorneys, and tax accountants that money could buy. So you have large corporations like General Electric that spend lots of money on lobbying and all these other experts, and they basically pay no taxes. In fact, they got a rebate. So when the Congress tries to penalize large corporations and passes new taxes, it just ends up only hurting businesses here in the United States that are small and medium sized, that can't afford to compete with the large corporations.
Yeah, I agree. I definitely agree. So let's also going back to talking about the stock market. Let's talk about the top performing sectors for 2016. I know you wanted to talk about that, so we did our homework on that, and a lot of the top performing sectors that might surprise people. On top of the list is energy, which overall had a 25% return for the year 2016, and guess what came second? The financial industry at 24%. And then we got the industrial industry that came in at about 21%, and material industry came in at 23%. And that's mostly the mining stocks, especially the precious metal stock that had a nice surge in the first half of 2016, where we saw a lot of the stocks double or triple in stock prices. And then we had the telecommunications service that had 14%. The industry that didn't do well, no surprise, is the healthcare industry, and I think that a lot of that has to do with Obamacare and all the regulation that's been put in place the past couple of years.
Well, actually, the healthcare industry was making record profits off that corruption in Obamacare. The reason in 2016, Mo, is that as Trump started to move ahead, on election day, people started to worry about the effects of Trump repealing it. We saw today that Congress, the House of, that the Senate just voted on Obamacare, right? And they voted 51 people to 48 voted to repeal Obamacare. So
well, the thing about that bill, that bill is to defund Obamacare, not to repeal the regulation or the rules from Obamacare. So, like providing coverage for pre-existing health care will still be in place. The mandatory fine if you don't join Obamacare, if you don't have any insurance, will still be in place. What the Republicans are trying to do is take the money from that Obamacare and create their own version of Obamacare or Obamacare 2.0, what they're calling it. So that's what they're trying to do. So Obamacare in some form or fashion will still be there, even with the majority of Republican in the House and Senate, I think.
What we really need, Mo, is free markets and open this up. We need, if you talk to people actually in the healthcare industry, my dad's a retired doctor, and what they say is that the patient's getting screwed and the doctor's getting screwed. There's not enough doctors for every patient, and the patient doesn't see their doctor long enough. So basically, you fill out a bunch of paperwork, and that's all the doctor looks at, and then you get a couple minutes with the doctor, and then he writes you all these prescriptions, and that's basically it. We just have so many doctor's offices now, Mo. Most of the people in the doctor's office are not patients or doctors or nurses. They're paperwork people. they're the paper pushers. There's probably 2 or 3 paperwork people for every doctor or nurse.
Yeah, I notice when I go to my doctor, there's like 4 or 5 people behind the desk making an appointment, filling out the paperwork for the insurance, and having people fill out all these forms. So yeah, I definitely notice that.
Yeah, so we need to get the government out of healthcare industry. There's a scheme with the hospitals that they get kickbacks to that drives the costs up like crazy. And we need competition for health insurance more across state lines. I think it's ridiculous how basically you could only shop for health insurance in your state. It's ridiculous. It's any other business. Almost any other business, you can buy a good or service across state lines, and you can't do that with health insurance.
Yeah, like car insurance. You can buy any type of car insurance from any company from regardless where they are. But with healthcare, you only can buy whatever provided in your area, which create a monopoly and increase its prices.
Oh yeah, there's the U.S. is not really free market capitalism like the people in Congress try to say. Oh, it's all capitalism's fault. I mean, there's tons of cartels, there's tons of government protected oligopolies or monopolies here. The NCAA, the National Collegiate Athletic Association, they're tax free. So they have a tax-free exempt. They're a non-profit organization technically. Even though they make billions of dollars, they spend millions of dollars a year in lobbying to protect their tax-exempt status. The NFL and Major League Baseball used to be tax-exempt too. So when I tell people that, most people aren't aware. Yeah. So
yeah. The NCAA makes tons of money every year, and they're getting bigger and bigger, and you could see like the football program. For the colleges across the country, they have these multi-million-dollar football locker rooms.
oh yeah.
Their uniforms are getting fancier and nicer, and they have different type of uniform for every game. So that's also a direct result of the college loan bubble as well. That's going on, and they're greatly benefiting.
Okay, so in the last couple minutes here, let's talk about commodities, precious metals, anything you're looking for in 2017, maybe a brief preview. I was reading some previews from some friends of mine. We're going to have them back on the show, whether it's Nomi Prinz. I just booked her for next week. So we're going to have her back on to talk about what she is looking for in 2017. Hedge fund manager.
I find it interesting that she was part of Bernie Sanders' economic board of advisory or whatever. I think you told me that.
Yeah. Well, she's a smart lady. I respect her a lot. She understands the reality of the situation, having worked on Wall Street and studied the banking system. She understands reality. I think she's just hoping, when you believe in a certain political ideology, you hope against reality. So, and I think that's what she views the world as. She wants to form the world a certain way, but she acknowledges reality is this and this and this. But yeah. I respect her a lot. I don't agree with her on everything, but I respect her a ton. I think she's very impressive.
Yeah, she does great work. I agree.
Yeah, so we've had an interesting 2016 in the commodity world. We've had bear market rallies, in my opinion, in oil, in copper, other base metals also, and it's setting up for a very interesting move going forward. We haven't seen a lot of investment yet in new mines, and I think that's probably a good thing. So a lot of these CEO, other than the oil companies, because I think the oil companies, are still making those investments. They drilled and capped a lot of shale oil wells. So if we get back to $60, $65 a barrel oil or higher, there's a lot of shale oil wells that were drilled and capped that can come back online, swing production, and can put a cap in the price. So I think we're going to see in 2017, I will write about this more when we write our 2016 review, 2017 preview with stock picks and trades, which, by the way, if you bought sorry, we didn't sell our last one. If you read our one from 2016 that we released in January of 2016, you've done very well on a lot of investments and stock trades in the report. But I expect very wide range in the oil price again in 2017. We know that the Russia, Saudi Arabia, the oil cartel and OPEC, they're trying to keep the price higher. But, if they move the price too high, a lot of shale oil production could come back online and knock the price back down. So it's going to be very interesting to see who wins that tug of war.
Yeah, and the rig count is starting to go back up after we saw also the OPEC. They cut their production. Yep.
That's a great point, Mo. And I would add what no one thought, including myself, no one in OPEC, no one, including myself, other oil experts, is no one saw how innovative and entrepreneurial these shale oil entrepreneurs and business owners would be about how to cut costs. So they've innovated with the octopus drilling wells and other ways. So the shale oil revolution, they started drilling these wells when oil was around $100 a barrel, $90 a barrel. and it was very economic. It was pretty economic then. They could generate some free cash flow. But when the oil price started falling, they were actually able to cut some costs. Now, a lot of these shale wells are still not super free cash flow positive, but they can kind of break even around like $50, $55, $60 a barrel now. Whereas, in the past, when I was looking at the numbers, when oil was around $65 a barrel, the financials of a lot of these guys, there was no way they were going to go bankrupt. So they have been able to cut costs and buy themselves time. I don't know how much more costs they can actually cut to maybe generate a little profit or kind of break even. But the oil market's going to be very interesting. I think it's going to be extremely volatile. As an options trader or a trader in oil, I think it's going to be good. As a long-term investor in oil, it's going to be difficult unless we see a big drop in oil prices. Then it'll potentially be a buying opportunity if you buy oil companies with a good balance sheet and low cost who don't have too much debt. But, it's tough to say if we're going to see oil back down to 29. We could if we see the global economy totally crater or, the central banks actually allow a crash. But, we've had a big drop in gold and silver. It was very, it's unfortunate, given the news that we've seen with the manipulation, how now conspiracy theory has basically become conspiracy fact. But unfortunately, with the Deutsche Bank news and them naming the 8 co-conspirator investment banks and being fined $98 million. But, it hasn't affected the price at all. So the paper price is still in correction mode. I don't think we're going to see every time, Mo. I don't know about you. I've been following gold and silver so long now that every time there's a pretty decent sized correction in gold and silver, the normal amount of newsletter writers, I'm not going to name their names, but everyone knows who they are, start saying, they start extrapolating the correction. Oh, gold's going to go to 700. Oh, gold's going to go to 400. Silver's going below 10. Silver's going to go to 4. So we always see those guys come out. But, I don't think we're going to see silver, if we do see a prolonged correction going forward a little bit longer, I don't think we're going to see gold stay, below 1150 or 1000 for very long, because the miners just can't keep the supply coming, at sub $1,000 gold or sub $13 or lower silver without starting to turn off the mines.
Yeah, the first half of 2016 was great for gold and silver. Silver went from $13.70 to about $21.23.
Yep.
And then gold went from about $10.50 all the way up to almost $1,400. And then we saw the big correction in the second half where right after the Brexit cooled off, and we saw that big jump. The downtrend started to happen in the gold and silver market, and all those gold and silver stock that were tripled and doubled in price came back down, which is unfortunate. But the fundamentals are still strong. The fundamentals have not changed in the past few years, despite the price dropping, because the demand is still strong for gold and silver, and the supply is limited, especially for gold and silver. So I think the prices will go higher. How high in 2017? Who knows? But it'll go high eventually. And I had Eric Haddock on a couple days ago, and he said that around the second half of 2017, we could see a jump. And the second, we called it the second leg of the bull market in gold and silver. So that's something people can keep their eye on, because he's been pretty accurate with the outlook for that market for the past 5 years. So something to keep your eye on.
Yeah, and Mo, prior to the correction starting in late September and October, gold and silver were the top performing assets, and the gold mining industry was the top performing sector, I believe. Yeah, so they were the top. I think Bitcoin was the top performing asset in 2016. I think it was up over 150%. We talked about it in our 2015 review, 2016 preview. We said Bitcoin was a good speculative buy when it bottomed around $250. We thought it was a good speculation there. If you'd bought it then, you had a quadruple at one point. If you had taken some profits around 1,000, maybe a little bit, sold a little bit off. But Bitcoin, ownings, I think from an insurance standpoint, Mo, of what these crazy academics and central planners, crazy politicians, what they have planned, what they're doing interviews on CNBC and Bloomberg talking about cashless society. They're writing white papers and books about it, whether it's Ken Rogoff or Larry Summers. The stuff they have planned, I sleep better at night if I have some cash out of the banking system. I have some money diversified in a couple different bank accounts. I own physical gold and silver out of the system, maybe some of it diversified in a gold money account in a couple different vaults, and then maybe a little bit of Bitcoin. So if you have that type of liquidity diversification, I would sleep a lot better at night, because, the people in power, they don't care about you and me. They care about protecting their power so they can make. A lot of them are more like Hillary Clinton in terms of their morals. So, they're going to change the rules. They're going to try to figure out how they can screw the most people over so they can keep their power or increase power and then increase their profits, with legal or illegal schemes.
Yeah, I'm glad Hillary's out of the news and out of TV and out of my Twitter feed and my Facebook feed, because I got tired of seeing her ugly, wrinkled face.
Well, she's supposedly going to run in 2020, Mo. I guess maybe she's going to run from the wheelchair or run from the the hospital bed. I mean, she has 12 seizures a day, I heard. So I don't know how she can run, but if there's still a corpse there, if she's not a full zombie, I mean, I guess they could just wheel her in, and she'll have the brainwashed Hillary bots voting for her still. And
yeah,
she'll have the media kissing her ass still too, the mainstream media.
Yeah, that'll never end. I think the biggest surprise for 2016 is a Trump victory. Because I think a lot of people, including myself, thought that Hillary was going to win because that's what the establishment wanted, and they will do anything they can to make sure that she won. But she ended up losing, and for multiple reasons. One of them is the progressive base simply do not like her. She got 2 million less votes than Obama did in 2012 election.
Yep.
She didn't go campaigning in Michigan or Wisconsin where she lost. Trump did. So he went over there and he talked to all the blue collar workers that are afraid of losing their job and made a promise to them that he's going to keep all the jobs in the country, and that's resonated with all the voters there. So, and Hillary Clinton did not do any of that. So that's the big downfall on her part.
Yeah, Donald Trump won the same way that Ronald Reagan won in 1980, and Hillary Clinton, a lot of the Bernie Sanders voters didn't vote for her. So a lot of Bernie Sanders voters either didn't vote, they voted for Trump, they voted for Gary Johnson, or they voted for Jill Stein. So
I definitely agree with that. So I don't see her running in 2020 because I think she did a lot of damage for the Democratic Party.
Yeah, she has set the Democratic Party back a lot with the scandals and the stuff that's come out in WikiLeaks. Now, Julian Assange of WikiLeaks has promised even more information coming out in 2017. I'm excited to see what's coming out in 2017 in terms of the information and WikiLeaks stuff. It'll be a very interesting year. I think it's going to be very volatile and difficult. I think the most volatility, Mo, in 2017 will be in currency exchange rates. So we saw a lot of that the last 2 years. One thing in 2000, before we wrap up the show here, the review show of 2016, we saw in 2016, Mo, basically unprecedented currency moves. So right after Brexit vote, we saw the British pound, I think in a matter of 2 minutes, due to high frequency trading computers and other traders, we saw the British pound move 6% in 2 minutes, and the British pound is down a record 14% for the year in 2016. So we're seeing record currency movements. The Japanese yen has moved an enormous amount just in the last couple of years. It's up and down. It's crazy. We've seen the dollar move a lot. So one of the footprints that these intervening manipulative central bankers who coordinate with each other or are competing for who can devalue the fastest or who can manipulate whatever market, one of the footprints they leave the most in, besides manipulating interest rates and their bond markets, is the currency markets. So I think a hedge for our listeners out there is going to be one way to make money is going to be trading currency ETFs. There's going to be a lot of moves up and down. It's going to be a yo-yo and head scratching for many of our listeners out there who live in different countries to see your currency exchange rates change so rapidly. This really didn't happen nearly that much in the past, but is going to be the new normal going forward as we see these Keynesian central bankers implement the race to debase faster. And, one of the ways to monetize this debt, to deal with this debt problem, and the debt problem has gotten larger since 2008. I don't think anything was really fixed after the 2008 financial crisis. I think, they created more debt. With a debt problem, they created more debt to try to solve a debt problem, which doesn't make any sense to me, and yet they did it, and they've gotten away with it with higher asset prices. So I think this is going to be, I wouldn't necessarily classify as every government mode is in a currency war, because we do know that the Federal Reserve is coordinating with the European Central Bank, and that they're coordinating with the Bank of Japan and the Bank of England. So we know some groups are working together, but I would call it the currency devaluation carousel for the ones that are working together. Now, the other guys on the other end are basically like the emerging markets. So what China's trying to do, Mo, is China's trying to prepare for the next global financial system. China set up their own currency swaps with, did you see they did a $2 billion currency swap deal with Egypt? That was a press release in November. And there's additional currency that Egypt can earn in RMB credit line. So they're setting up over 30 currency swap deals to internationalize their own currency and prepare for the next global financial system.
Yeah, I think 2017 will be an opportunity to short a lot of stock more than go long, in my opinion, because I'm seeing a lot of stock that are good shorting opportunities, either shorting stock or you just want to buy put option on them. So I think 2017 will provide a lot of opportunities for traders to do that as well.
Yeah, and I'm going to run my proprietary valuation formulas for undervalued small cap and mid cap growth stocks, companies that can generate free cash flow with good margins. And we're going to plan on putting at least a handful of those into our report. Yep. And we're going to be charging for this report, guys, because the last report we did, I started writing that report in November of 2015, and we didn't finish it until January of 2016. So it took over 6 weeks of hard work to get that thing done and produce it quality. So, I'm not going to do that for free anymore. We're going to do the podcast. We're going to release these interviews for free, but for in-depth analysis with stock picks and stuff that are high quality retail, investment or trading research, obviously it's our own opinion on stuff. You have to do your own due diligence or talk to your financial advisor. But for that level of research or hedge fund quality research, you're not going to get that stuff for free.
Yeah, and we are going to also put out more products and services for our customers as well, other than the report. That'll be coming sometime this year. I know you may or may not know, I've been surveying a sample of our followers to try to get their feedback on our podcast and Wall Street for Main Street. So we're going to take all that information and data and try to help you guys become more educated in the finance and economic world.
Excellent. Well, we're a little over an hour, so I think we'll wrap it up here. If we forgot anything else, we're going to include it in our report. But do you have any more closing thoughts before we sign off?
I also want to mention that the podcast that's coming up in the next few weeks. I was supposed to do an interview with a healthcare expert before the holiday kicked in, but I had audio problems, so I had to postpone it to after the holiday. So I'll be having a former doctor now writing about healthcare and how to fix it, and she's also against Obamacare. She's a free market healthcare expert, so I'm going to have her on to talk about the healthcare industry in the next few weeks. And also we're going to have a personal finance expert come on as well to talk about how to tackle any debt problem you may have or any budget problem that you may have. She's a certified financial advisor as well, so that'll be a good podcast.
Great. Yeah. So, we've been covering a lot of different areas of interest, whether it's oil and energy investing, value investing. It's tough to get technology experts on. We do try to mix in other types of quality content. I'm going to try to get Chris Whalen on in the near future here to talk about his new book about the banking system and what he thinks about it. So we've had him on in the past. He's a banking system expert. I'm planning next week on getting David McIlvaney back on. We're going to get Dominic Frisby back on, who I've had in the past. He wrote a book on Bitcoin, and he's also researched gold and silver a lot, and he lives in London. He's a famous actor and comedian there. So we'll be asking him about updates on Brexit as well. So thanks for tuning in, guys. Mo already wished you a happy new year. Buckle your seatbelts, put on your safety helmets, and do some yoga stretching and stretch out your neck and your back, because this is going to be crazy going forward. These central bankers, these politicians, the stuff these guys, if half of the stuff they're planning actually comes to fruition, man, it's going to be a very interesting next couple years. The thing is, we had our last major global financial crisis in 2008, Mo. Now, since the Federal Reserve really started intervening in markets again, and the dollar was separated from gold in 1971, we basically had a major global financial crisis every 7 to 12 years. The Alan Greenspan Federal Reserve was the one that was massively interventionist. And, it's basically just compounded and been magnified after that. Basically, if you add up the numbers, 12 years to after 2008's 2020, I don't think we're going to make it to 2020 before the next one.
Yeah, I don't think so either. I think it's possible that we're going to have a major economic crisis before the end of this decade.
It could even be, Mo, before the end of 2017. There was a Deutsche Bank analyst there talking, and he even said this. He used the analogy of plate spinning. So you know how, like, at the circus or at, like, the halftime of a basketball game or a not hockey game because there's ice, but like a basketball game or a sporting event, how, like, there's, like, circus people spinning plates. And he was like, basically, like, there's too many plates and they're starting to fall. I like the analogy better, how we're in an economic minefield. But pick your analogy, one of the two. I think they're both pretty good.
Yeah, definitely. Yeah, that's a good one.
Okay, guys. Well, that's it. And I'm watching the Caps right now destroy the Columbus Blue Jackets attempt at a record 17-game winning streak. So that's
you know what's a big surprise for 2016? That the Chicago Cubs won a World Series.
Yeah, we had a horse Triple Crown winner. We had a Miguel Cabrera. We had Miguel Cabrera hit for a baseball Triple Crown. We had the Cubs win a World Series. So we've had some crazy things in the last few years I didn't think would happen in my lifetime. The Red Sox have won a World Series. So it's very, very interesting times now.
Miguel Cabrera won the Triple Crown this past season, or that was a couple of years ago?
That was a few years ago. But the horse Triple Crown was done, 2015?
That was 2015, yeah.
Yeah, it was 2015. But yeah, I didn't think I would see that. I didn't think I would see that in my lifetime, because normally, like, the horses, they win the Kentucky Derby and they win the Preakness, and then they get to the long track at the Belmont and they can't run the extra distance.
Yeah. Well, maybe we'll see the Cleveland Browns and Philadelphia Eagles win a Super Bowl in our lifetime. We'll see.
Hey, I'm a Dodgers fan, so the Dodgers haven't won a World Series since I was 6 years old. So 1988. It's been a long freaking time. It's been a painful. The Dodgers have at least made the playoffs a lot, but they've always had good or mediocre teams.
And I'm an Orioles fan. They haven't won since I think it's early 80s. I forgot what year it was, but I think it was 86 or 82 or something like that. But they've been horrible.
I think Cal Ripken was a young player the last time they won.
Yeah, I think it was the second year, third year of the player, yeah.
Okay, well, Mo and I could talk about baseball off recording here, guys. So that's it for this show. There will be more in-depth analysis, reviewing 2016, previewing 2017, and also with long-term stock picks of undervalued stocks. We had a lot of winners in our last report, which was free. This one will not be free. A couple of the stocks were actually up 78% in only a year. So, and they were profitable. They weren't like junior mining stocks. So they were actually companies that could make money.